Okay. Turn to page 449. And I know we haven't started chapter 15 yet, but while we're in the math mode, I want to work through.
Oh, we probably already went over users.
No, we have not. I'm going to come back and finish it. Yep. 449. Page 449. So I always introduce this chart to you early in the class so that you have time to get it memorized. You have plenty of time in the next 2 weeks to get this chart memorized. So this is a loan factor chart. A loan factor is just a payment per $1,000 borrowed. So if I borrow $1,000, this is my monthly payment based on an interest rate and a term. A term just means the amount of time that I've borrowed the money for. So what's the most common term for a residential mortgage? 30 years. What's the second most common term? 15 would actually be the second most common. That's not a test question, but 15 is the second most common. So the chart is just a principal and interest payment if you only borrowed $1,000. So for example, if you look in the chart at 4.5% interest for 15 years, what is the loan factor for that? 7.65. Well, let's call it what it is. $7.65. This is a payment. So if I borrowed $1,000 from Bank of America at 4.5% interest for 15 years, how much would my monthly payment on that loan be? $7.65. So here's where the really hard math of loan factors comes into play. What if I borrowed $2,000 from Bank of America? What would I do with that number? What if I borrowed $5,000 from Bank of America? Now, let me really test you. What if I borrowed $150,000 from Bank of America? Multiply it by what? 150. See, it doesn't get any harder. We make it harder. If we borrow $1,000, what are we multiplying that payment times? 1, right? Change the comma to a decimal point. If we borrow $2,000, what are we multiplying that payment times? If we borrow $2,000, what are we multiplying that payment times? Change the comma to a what? A decimal. If we borrow $175,500, what do we multiply by? 175.5. Just change the comma to a decimal point because it's a payment per 1,000, right? Does that make sense for everybody?
What page is this on the slide?
I don't remember. Does that make sense though? All you got to do is find the number in the chart and multiply it times the number of thousands that you've borrowed. And the best way to figure out the number of thousands that you borrowed is just change the comma in the loan amount to a decimal point. That's all you got to do. That's it.
So this chart will, like if we have a word problem based off of it, will it tell us these?
No, that's what I told you. You have to memorize the chart.
Are they going to provide the chart in the test?
Yes, they give you the chart in the test.
Will it be this chart, or will it be like this could be anything?
This is the chart.
This
is the only chart. This chart is forevermore. It's been the same because this is the payment per 1,000 based on these factors. This was your cell phone before they existed. When I got into the business, there was no such thing as a smartphone. I had a Motorola StarTAC. You remember what that was. If I wanted to talk to a client about how much their mortgage payment was going to be, I had a little thing in my pocket that the bank gave me. and I had to slide it up to an interest rate, and then it had a little wheel on the side that I would turn around 15, 20, 25, 30 years, and then there was a little red window in the middle, and that would have a number in it. Well, guess what number that was? It was a loan factor. And so here's how this still comes in handy, folks. Look, do me a favor. Look up 4% interest rate, 30 years. That's pretty much where we are on 30-year notes right now. So at 4% for 30 years, what are you at? $4.78 per thousand, right? Here's how that is still super useful for you. You're going to be showing houses to people, and people don't shop anymore for anything by price. They shop by what?
Monthly payment.
Monthly payment. Think about when you go buy a car. It is the most obnoxious thing in the world. You can't even get a salesman to talk to you about how much the damn thing costs. They're like, oh, well, that one's only blah, blah, blah for a month. I don't want to know how much it is a month. I want to know how much it costs. That's me. But how do most consumers shop for things now? Because we're so debt-laden as a society. How do they shop? Monthly payment. And that's exactly what this is. It's a way to shop by monthly payment. If I'm showing somebody a house, one house that's $100,000 and another that's $105,000, the difference for them is not $5,000. The difference for them is $478 a month times what? $100,000, $105,000. I want you to make this connection. How much money is different between the two? $5,000, right? So how many times that payment is it? 5. So if I'm showing them two houses,
They're like
$25, $24 and change, right? What is the difference? 478 times 5, what is it? $23.90, $24 a month. So if I have a buyer who's looking at a $100,000 house and a buyer who's looking at a $105,000 house, I can look at them and say it's $25 a month.
Assuming you know that they're getting that interest rate.
Well, I know that's what 30-year interest rates are right now.
But doesn't that also depend on like their credit score?
Largely not. At this point in time, if you qualify for a loan, you qualify for a loan. The best borrower might get an eighth or a quarter better than the worst borrower.
We shopped ours around and got it substantially lower than the first offer.
But the other thing is here, we're not trying to give them exact things. Look at these charts. Look at the difference between 4% and 4.5%. Right? You see what I'm saying? So if I just figure $5 per thousand, I'm pretty dang on close. Do you understand how that's a useful thing in the real world with a person? Because here's the thing. Though they can't test you on what's useful in the real world, if you understand why this is useful in the real world, the math becomes easy. Because the math is real world in this case. Why do I care what the payment per thousand is? Because I can instantly tell somebody what their what? Their monthly payment is. All I got to know is how much they're borrowing. And for most people, how much they're borrowing is based directly on how much the cost of the house is. I can instantly fire a payment at somebody, and all I got to know is how much money they want to borrow. Because I know how much the payment per thousand is. Does that make sense? You with me on that? I'm getting ready to find out. So you better be honest. Okay? All right. Let's take a look at the worksheet. Using the loan factor on page 449, identify the correct monthly principal and interest payment for each $1,000 borrowed on a 15-year note at 5.5% interest. So they're not even asking you to do any math. Can you read the chart? That's all they're asking. Identify the monthly PI payment for each $1,000 borrowed on a 15-year note at 5.5% interest. Well, when I look, I have to put down something straight so I can see.
It's 6.5%.
5%, 5.5%. Number 13. Number 13. For a 15-year note, 5.5% interest, I see $8.18.
That's number 13.
Yeah, that's what I got.
Is that what everybody sees? $8 and how much? $8.18. 8.18. And remember, that's per thousand, right? So if we wanted to figure out a total PI payment, we'd just be multiplying times the number of thousands that they borrowed. So that's what we're doing in number 14. That's per month. That is principal and interest per month. So calculate, number 14 says calculate the monthly PI payment for a $50,000 30-year fixed rate mortgage issued at 6.5% interest rate. So the first thing we need to do here is find our loan factor. We need to go to the 6.5% row and look over at the 30-year column. I see $6.32. Does that sound familiar? $6.32 per thousand, right? So now we need to know what to multiply that by. Well, I'm going to write down my loan amount as $50,000, and I'm going to change the comma to a decimal. So 50.0 is what I'm multiplying by. So $6,316. That's my monthly payment on that loan, $316 a month for principal and interest. Principal and interest. Try. Yes.
So why wouldn't we have to change the $50,000, like divide that by 12? Because, oh, never mind, it's the 30-year.
Okay, you good?
Yes.
Okay. Because the $50,000 just tells us how many times we're making that $6.32 payment. You know, we're making it times 50. All right, number 15. Calculate the total monthly PI payment on an 80% loan-to-value loan used to purchase a $360,000 home in Raleigh if the borrower elected for a 30-year fixed-rate note at 5.25% interest. So the wrinkle they've added here is they didn't give you the loan amount. Okay, but still, step one's always going to be find our loan factor. So I'm going to the 5.25% interest row. I'm going all the way over to 30 years. That looks like $5.53 to me. That sound about right? $5.53. Now it's $5.53 per thousand, correct? You're looking at me funny.
Well, don't we have to do
Don't we have to do what?
360 times 80%?
Yeah, we got to, but we don't need that until we know how much per thousand. That doesn't have any impact on the payment per thousand.
I thought this was based off the loan. Okay.
Yes, to know how many, to know what to multiply this by is based off the loan. But that number has nothing to do with whether I borrow $10,000, $20,000, $8 million. This number right here is exactly the same no matter what I borrow, right?
Yeah, you're right.
Because that's the payment for every $1,000 I borrow.
So the only thing
Right.
we can know for the chart is just the 30 years
And the interest rate, that's exactly right. So all I'm doing is writing down how much the payment is per thousand. Now I need to figure out how much the loan is. Okay? So I've got to take my $360,000 purchase price and multiply that times the 80% loan-to-value ratio. And I get a loan amount of $288,000, right? And again, all I got to do is change that comma into a decimal. So that's what I multiply by my $5.53. So $5.53 per month times 288. 1592.64 is my monthly principal and interest payment on that $288,000 loan. So if I borrowed $288,000 at 5.25% for 30 years, my monthly payment will always be $1,592.64. Okay? Everybody good with that? See, the nice thing about these numbers is they don't change. They never change because an amortization table is what it is. So as long as you know the interest rate of the loan and the term of the loan, you can calculate the monthly payment on that loan if you have one of these charts. And you'll look like a genius with your clients. Well, how do you know that? It's magic. It's magic. I'm just that good. Now, take a look at number 16. Number 16 is one that throws people for loops, and it's the easiest math in the entire class. But we make it so much harder than it needs to be. Because let me tell you something, folks. I don't need to know this number at all to answer number 16. Number 16 says, what is the interest paid over the life of a $130,000 fixed rate, I don't care mortgage, with monthly principal and interest payments of $506,000? See, people think because it's asking me for the interest paid over the life of the loan that I need to know the interest rate. I don't. Because they told me the monthly payment. That's what I need to know. I need to know the monthly payment. How much is the monthly payment in this case? $506. And how many times a year do I make a monthly payment?
12
Times 12 months. That gets me to 1 year. How many years did I borrow this money?
30.
Times 30 years. That's going to tell me the total amount of principal and interest that I pay over the whole life of the loan. So how much is the total amount of principal and interest that I pay over the whole life of that loan? 182? 182,160. $182,160. But remember, this is a PI payment, so this is a PI number. What did they ask me for, though? They asked me for just the interest. So how do you get from principal and interest to just interest?
Subtract that 100,000.
Subtract the principal, right? And the principal in this case is $100,000. So I paid back $182,160 minus what I borrowed, which was $100,000. So I paid $82,000, $82,160 in interest. How are we on that? Again, it's just another way to think of these payments, right? Interest paid over the life of the loan is just going to be the total paid over the life of the loan minus the principal that you borrowed. What other way could I have done it? I didn't need the rate. And so what other way are you proposing I could do it?
So using the rate.
No. I can't get there using the rate. That's what I'm saying. I do not need it. It is completely extraneous information. What I need is the monthly payment. That's right. The only thing the rate is useful for is to find the monthly payment in that chart. That's the only thing the rate's useful for, is to find the monthly. But I didn't need it because they gave me the monthly payment. It's the only thing the rate's useful for. I can't do any math with the rate to get to that answer. You cannot take that loan amount and multiply times 4.5% and then sometimes some magic number. It doesn't work that way. You need the monthly payment for principal and interest. How about number 17? What would be the interest paid over the life of the same loan in the question 16 if the borrower elected for a 15-year term? So you guys work on that one. A 15-year term with monthly PI payments of $739. So just look back and repeat the exact same steps. Good. So, step 1 is to calculate how much I pay over the life of the loan for total of principal and interest, right? So I have my monthly PI payment of $739, and I always pay that 12 months out of the year. And in this case, how many years did I borrow the money? 15. So I'm only going to times 15. I'm only multiplying times 15 years this time. And what do we come up with for a total of principal and interest paid over the life of the loan? 133. How much? 020. $133,020. That's PI. But they want to know just the I, just the interest. So that's going to be 133,020 minus the $100,000 that I borrowed, and the interest is going to be just $33,020. Substantial difference, right? 82,160 versus 33,020. What does number 18 ask? For the difference between the two. In case you haven't noticed, folks, all I did is took what's eventually going to be one question and made it into what? 3 questions. So if you ever get a question that says, what's the difference in interest paid over the life of 2 loans? You're just doing what we just did as 3 questions, but all as 1. Okay? So the difference between the two is just going to be 82,160 minus 33,020. $49,140 is the difference in interest paid over the life of those 2 loans.
I mean, yeah, I was about to say, if you just went 15 years, you could have bought a nice car.
That's right. Now, number 19 combines a couple different ideas. How much interest is paid over the life of a loan, an 80% loan-to-value loan that's used to purchase a $240,000 home, if the borrower opts for a 15-year fixed-rate note at 6% interest? Well, I can tell you a few things they didn't give us here. Number 1, they never gave us the loan amount. They gave it to us as what? As a loan-to-value. Another thing, anytime I'm talking about interest paid over the life of the loan, I need a monthly PI payment. Guess what? They didn't give it to us, but we have what? We have a chart that we can get there. So, if we look at 6% interest and a 15-year note, I see $8.44 per thousand. Does that sound familiar? $8.44 per thousand. So now all I need to know is how many thousands we are borrowing, correct? Which they didn't give me, but what they did give me was a loan-to-value ratio. So can I not take the $240,000 purchase price and multiply times my 80% LTV to come up with a $192,000 loan? Is everybody okay so far on that? Now, once we got a $192,000 loan, can we get to a monthly payment using our loan factor? Yes. All we do is change the comma to a what? To a decimal, and so we multiply that $8.44 times 192. And what do we end up with a monthly PI payment? $16.20 PI times 12 months a year, right? Times how many years? 15. So what is the total paid over the life of that loan? $291,681. 686 and 40 cents. Okay, so my total principal and interest, because once I get to a monthly payment, I'm just multiplying that times 12 months a year, times 15 years. My total principal and interest paid over the life of that loan is $291,686.40. But how much of that was borrowed money? Well, that's the rate. But how much of this 291 was actually borrowed money? 192. That's my loan amount, right? That's the amount I actually borrowed. So if I want to figure out how much interest I paid, I've got to subtract the amount I actually borrowed. So if I subtract out the 192, $99,686, and how much? 40 cents in interest paid over the life of that loan. Now here's where I want you to take a moment and be proud of yourself. If I had asked you that question even 10 minutes ago, you'd have looked at me like I had three eyes in my head. Think about how quickly you pick this stuff up, right? When you start combining the... If you haven't quite got it yet, that's okay. I mean, this is a lot, because that is a long way to come in 15, 20 minutes from not knowing how to calculate the interest paid over the life of any loan to being able to not only calculate the loan amount, the monthly payment, the interest paid, the principal and interest paid over the life, and then get down to the interest paid over the life. That's a lot of steps that you built yourself through in a short amount of time. Is it making sense? Okay, good, good. Number 20, how much additional interest would be paid by the same borrower in question 19 over the life of their loan if they opted for a 30-year note at the same interest rate? So all we're going to do now, we got to figure out a new monthly payment, correct? So we go back to our chart. Same 6% interest rate, right? And it's $6 exactly is our loan factor. $6. Are we still multiplying times the same loan amount? And how much did we figure that we were going to be multiplying by before? 192. Stays exactly the same because we're borrowing the same amount of money. So $6 times 192 equals how much? $1,152 PI, right? Per month times how many months? 12 months a year times 30 years. What do we come up with for total PI on that loan? $414,720 PI. And then of course we can subtract out our loan amount, right, of 192 principal. And how much interest do we pay on that 30-year note? $222,720 in interest on that 30-year note. And the question was how much additional interest we paid on the 30-year, right? So how would we calculate how much of that is additional interest? We would subtract the interest on the 15-year from the interest on the 30-year and get the difference between the two. So we're going to come over here and we're going to take the $222,720 for the 30-year note and subtract the $99,686.40 for the 15, and that's how much? $123,033.60. That is the additional interest by taking that out to 30 years versus 15. Another $123,000. Cheap, ain't it? Interest is, I'm not even going to say what it is. I'm on video, right? It's tough. Well, you think about interest rates this way. If you just think about a sort of standard $200,000 mortgage, right? An additional 1% interest per year, folks. That's another $2,000, right? So if somebody's interest rate goes up just 1%, that's an additional $2,000 a year in interest that they pay. Divide that by 12, that's $167 a month. Just in additional interest for a 1% rate change. So when you start looking at something like an adjustable rate mortgage that might adjust 3, 4, 5% in some cases, what is that going to do to a house payment? I mean, so if you take a $200,000 mortgage and you get a 3% adjustment in the interest rate, the payment just went up by $500 a month.
Wait, so I got a question. So when you do get when you get the opposite of the fixed rate, it changes your monthly payment, and they'll just give it to you all of a sudden, or would it turn into like a partially amortized loan?
So if you get an adjustable rate mortgage,
Yeah.
and the rate goes down, is that what you're
No,
asking?
the rate goes up.
Yeah.
So they change your monthly.
Yeah, the payment changes.
Oh, okay, that's what I
That's
wanted to know.
exactly right.
If
No.
the payment stayed the same, that means you would have a partially amortized.
Right, because you wouldn't be paying it off. That's exactly right. No, the payment goes up.
Oh, okay.
How often will they change it?
Depends. We're going to talk about the different types of adjustable rates. It depends on the time. So like a 2-year ARM, for example, the rate would be locked for 2 years. And then 2 years after that. So it could change every 2 years. A 5-year ARM could change every 5 years. Okay. Well, but don't say no thank you until you look at what's involved with it. I mean, everything has its pluses or minuses. Some ARMs make sense. Well, how about if you could get a 5-year ARM at a 2% interest rate and you knew you were only living in the area for 4 years? Well, see, but you said no thank you before I even told you what the situation was. So what I mean about this finance stuff is you always have to do the math. It's always about the numbers. Finance is about the numbers. Work out the numbers. See what you're paying. See what your clients are paying, ultimately. But this, I'm sorry? Sometimes you could refinance. Maybe if you plan to refinance. So I'll keep that low rate for a few years and then I'll refinance into a fixed rate. Absolutely. Okay? Are we good on dealing with breaking these payments down into principal and interest pieces and then sliding those pieces around? Okay? Good. Good. I like it. Okay. So let's pick back up and finish up chapter 14, and then we will get into chapter 15. All right. So, as far as repayment goes on these loans, slide number 64 is where I am. So the repayment plans of these mortgage loans, the most common and the one that we've been dealing with in all the math examples, all your math will be based on this type of loan. The fixed rate level payment loan. A fixed rate level payment loan is one in which the interest rate never changes over the life of the loan, and therefore the payment also never changes over the life of the loan. Okay? So that's where you're going to be as far as all your math. And this is by far the most common mortgage setup for a home loan. Doesn't mean they all are this way, but this is by far the most common one. Yeah, I'm talking about slide number. Sorry.
So you're looking at page 64.
Yeah, no, not page 64. Let's don't go back that far. Slide 64. Oh, it's got page numbers too. I'm sorry. The slide number's up in the top right corner up there. Sorry. Okay. Term loans or interest only They mean the same thing. A term loan is an interest-only loan. So what do you think you're paying in a term loan? Just interest. So is a term loan going to have a balloon payment at the end of it? Yeah. Pretty big one. How much is it going to be? Exactly the amount you borrowed in the beginning, because you never touched the principal. The only thing you're paying on a monthly basis is the interest that is accruing for that month. So you're never actually touching the principal balance. So I see the questions, and the questions are good because this is what you have to ask yourself. Why? Ariana's back there like, why the hell would anybody do that? That's a good question. You want to try to take an answer at it? Why would somebody do that? What's the payment on one of these things going to look like? Compare this to a fully amortized payment. What's it going to look like? A lot less. It's going to be significantly less than a fully amortized payment would be. So ask your question again. Why would somebody do this type of loan? They don't have the money to do what? To pay a fully amortized payment. They do it for the payment. That's why they do it. The motivation for this is plain. It's clear. If they could afford a fully amortized payment, guess what? They'd be making it. They can't. How are they going to afford that balloon payment? Gosh, I don't know. Maybe refinance and do the whole thing over again. Well, it may be insane to you, but it might work for them. See, what you have to do is open your eyes to the fact that it's not just your situation. For you, this might not make sense. For me, this certainly doesn't make sense. But if you have a cardiologist who's doing his residency or her residency at Duke right now, and during their residency they make like $75,000 a year, but in 2 years this person's going to be making $500,000, $1 million a year. But he's already married. She's already married. They have kids. They want to get their family settled in somewhere. And they want to go ahead and begin to live the lifestyle of a cardiologist. Are they at a point in their life where they want to minimize those payments? Could this kind of a loan work for them? With the plan that they're going to do what as soon as they're making that $500,000 a year? They're going to either start paying it off or they're just going to refinance into a more standard. Maybe they go all the way from a term loan down to a 10-year mortgage or a 15-year note, right? Because at that point they can afford those big payments. So you see, there are situations where these things might work and be applicable. The problem we run into is when we start applying. Here's what this is not meant for. This is not meant for your Aunt Martha to buy a house with. And truthfully, if you want to get to the root of the financial collapse that happened in the 2000s, it's because we took exotic loan products. Exotic just means weird, out there. It doesn't mean they're bad loan products. It just means they were meant for very specialized situations, and we started using them for regular homeowners. I'll show you one. In fact, I'll do it on here. It's easier to show you on here. Yeah, we could just play The Big Short. Let me show you a loan. There was a company called World Savings. And World Savings had something called an option ARM. What does ARM stand for? Adjustable rate mortgage. Well, let me show you what the option part looked like, except they didn't say this on the top of the statement. Here's what they had written on the top of the statement. Pick a payment. That's what the mortgage statement said every month. Now remember, these are adjustable rate mortgages, right? So the rate could do what over time? Could change. So, when you got your statement every month, this is what you saw across the top of it. Pick a payment. And there would be 3 or 4 boxes here. And the top one would say $1,876. Minimum, oh, I can't spell today. minimum payment. And the next one would say $2,043 term. And the next one would say $2,315 fully amortized. Now your standard homeowner is expected to know all that terminology, right? We've been through this terminology. What does fully amortized mean? It means you would have to make this payment if you wanted to actually pay your loan balance down to what? 0. What does term mean? Interest only. So if you make that term payment, what's happening to your loan balance? It's staying exactly the same. If I check this box and sent in that check for $1,876, and by the way, is that the one that was most commonly checked? Is this covering the interest that's accumulating monthly? No, it is not. So if I paid $1,876, what's happening with that other $167 in interest that I'm not even paying off? Not only am I not even covering the interest, and not only am I not paying down the mortgage balance, my mortgage balance is doing this every single month.
And you're paying interest on your interest.
We call this negative amortization. So, those people who had that loan and were making that minimum payment every month, their loan balance was doing what? Michaela said it should be illegal. Gosh, you mean we should regulate financial institutions? No, it's not. It's not illegal now.
But they require loan to value. You're basically growing out of your loan to value ratio.
Sure, of course you are.
But you signed up for it.
Well, so now, let me carry this to its logical conclusion. Now, we haven't even talked about the ugliest part of this thing. These payments are based on that initial teaser rate that they gave you, that 3% interest rate when you took this loan out. These payments are going to change. First of all, these payments change every month anyway, because if you make the minimum payment and your loan balance goes up, does not every single one of these payments become a new number the following month? And every one of them is what? Higher. So automatically, if you're making the minimum payment gets higher and higher and higher every month, because more and more and more deferred interest is accumulating, and now you're paying interest on the interest. Right? What happens when the interest rate goes up 2%? Now, 2% was a modest jump in some of these cases. Let's say this is a $400,000 loan. What's 2% of $400,000? $8,000. Divide that by 12. Divide $8,000 by 12. Just say $700 among friends, right? Add $700 a month to every single one of those payments, and tell me what that homeowner does. Well, here's what the bank would say to you: don't worry. We will refinance you, because your home is going up in value so fast that none of this matters. And so next year when that interest rate resets, we'll just refinance you. Never mind that the next time you refinance, people were pulling cash out so they had enough money to do what? Make the damn payments. They were actually borrowing money so they could continue to make the payments and stay in the house. And these companies, like World Savings, refinance those people 3, 4, 5, 6 times. And you better remember this, and I'm not making a political statement, by the way. Don't y'all accuse me of making a political statement. I'm not. But when they start talking about repealing the reforms that came as a result of this is what they're talking about going back to. This is what your representatives in Congress, when they vote to repeal the Dodd-Frank Act, and that's not a political statement, when they vote to repeal it, this is what they want to go back to. Because what this results in is foreclosure. And not one, but millions of them. Because this is a house of cards that will collapse. That's my soapbox moment for the day. This is crazy. And the only way this went on was through outright fraud. Because people lied on those loan applications. And you know why they lied on those loan applications? Because they were told to by the banks themselves. The banks did. The banks sat in front of them and said, well, you know, to qualify for this, you need to make $250,000 a year. You do make $250,000 a year, right? Because we're not going to check. That's how it worked. You allow lenders to run around without regulation. You know, I had a picture of that one lighting a cigar with $100 bills. That's what you get. I'm telling you, you allow anybody to run around without regulation. You allow real estate brokers to run around without regulation, guess what happens? People get cheated. You allow mortgage lenders to do it without regulation, people get cheated. That's it, and that's it. It is, but there's no question. But we all, and so when I get on this soapbox in classes, I always tell people, we as real estate brokers are just as guilty. We participated. You know, we put people in houses they couldn't afford across the country. I'm not saying us, me specifically, or anybody else. But I'm saying these things matter. These financial topics matter a tremendous amount. Because the kind of loan your client ends up with, and by the way, World Savings, you ever heard of them?
Nope.
Not many people have.
They made a lot of money.
Most people have heard of the company that absorbed them. Where are these folks? You know why they don't exist? Because they bought World Savings. They paid $25 billion for World Savings, and World Savings' whole portfolio of loans was nothing but these pick-a-payment, option-arm loans, and every single one of them defaulted, and Wachovia went out of business. That's the end result. The end result is disaster of those kinds of things. So when we talk about this stuff, it does matter. So understanding something like a term loan, it matters. Sorry for my soapbox moment.
That was awesome. It was very informative.
Yeah, well, good. Good. It does. I get so ill. I get so upset. I do. Because I hate to see people get taken advantage of. It really drives me crazy. And it happened a lot. Okay?
To be a good broker, you have to really look out for your clients.
You do.
I mean, at the end of the day, you push them into stuff they can't afford. Like, what kind of reviews?
So, and obviously we walk a fine line. We can't give financial advice, but here's one piece of advice I think you can give, and I give to my first-time homebuyer clients all the time. When they get qualified for a loan, the first thing I ask them is, okay, how much is that payment? And they give me a number, and I say, how much is your rent right now? And they give me that number. And almost always, what do you think the comparison between those two numbers is? I wish. It's more.
You also have to take into account all the other expenses that come with owning a house.
Oh, I know, but it's already more. That's the problem. They don't think, and see, they don't think about that. They go to the bank, and the bank says, oh, well, you qualify for this. And they just hear that number, and they're excited to go buy it because it's new. And so I say to them, I say, well, how much is that payment? And they say, oh, it was $1,200. So how much is your rent right now? Well, we pay $1,000. I say, okay, what are you doing with the $200 that you're saving every month right now? And I ask them that. I don't say, are you saving $200? Because they instantly understand, they get defensive, right? I'm coming at them from the side because I want to catch them off guard. I say, what are you doing with the $200 you're saving right now? You putting it aside for a vacation? You buying yourself something? Oh, no, why? Do we need some money for closing costs? No, because if you're not saving $200 right now, you're not going to be able to afford that house payment. See, that's just common sense, but they don't have it. They don't have it. Okay? All right? Adjustable rate mortgages. We just talked about them. What's the key thing to recognize an adjustable rate mortgage. The rate does what? It adjusts. I heard it goes up. That's probably the truth in most cases. Well, and it is the truth really, because here from a test-taking standpoint, why would somebody get an adjustable rate mortgage? Why would somebody agree to take out a loan where the rate could change versus just getting a fixed rate mortgage? What's the incentive to do that? A lower rate to start out with. That's exactly right. That's why you choose the adjustable rate route, because the initial rate is lower. So other things that you might see with adjustable rates is this idea of a teaser rate. That's just that first initial rate. Okay? You don't need to know any of these different indexes. You don't need to memorize them. Just know that the interest rate on an adjustable rate loan is always going to be tied to some type of a public index. It's always tied to some type of a public index. Yes?
Maybe this is a really stupid question and I'm just lost, but what is the difference between an adjustable rate mortgage
And discount points, because they both change the.
They do. So discount points, it's a good question. Discount points don't adjust the rate during the loan. When do discount points change the rate? At the very beginning. And how long is that rate going to stay locked in? The entire term of the loan. An adjustable rate loan, the rate is going to fluctuate during the course of the loan. Okay? That help?
Yes, thank you.
Good. Generally speaking, no, you're not going to be doing discount points with an adjustable rate. I don't know if it's possible or not. I've never seen it. I don't think so. Okay? Most ARMs don't include a prepayment penalty. Well, most loans don't include prepayment penalties anymore. And then sometimes they can be converted. The big thing to know about them is the interest rate can change. And usually the incentive to do them would be that the initial interest rate is lower than a fixed rate loan. A lot of people get them with the anticipation that they will refinance them into fixed rate loans at some point in the future. Sometimes you get them because it's all that's offered. Lots of times in the commercial real estate world, adjustable rates are the only things offered. Okay? I'm not going to talk about graduated payments. Balloons, we've talked about that. A balloon payment is any time that the loan's not fully amortized. In other words, the payment is not enough to pay the balance all the way down to what? Zero. So there's some amount left over at the end. Now, a buydown is very similar to discount points. A buydown is very similar to discount points, except a buydown is temporary. Discount points change the rate or lower the rate for how long? The whole term of the loan. So if it's a 30-year loan, the discount points are going to lower the rate for how many years? 30 years. A buydown is only going to do it for 3 years. A buydown is going to only lower that rate for 3 years. It's a tease. It's going away. I'll tell you who does this. Builders do this. And again, what would be the motivation? Why would a builder offer to buy a buyer's rate down in the beginning for the first 2 or 3 years?
It's a new neighborhood or a new area, and they want to incent people to come by.
Yeah, they want to incent people to come into a new area. What else? What is this going to do as far as the buyer's afford? First of all, lower interest rate is going to lower what? Monthly payment. You lower somebody's monthly payment, can they afford more in sales price, a bigger house? Why would a builder do this?
They're going to get a whole bunch of big houses on their lot.
Because it incentivizes people to buy more expensive homes, because they're going to be qualified based on the lower payment at the beginning, not the higher payment that's coming down the road. Most common example of this would be a builder. Do this as an incentive. And the most common one is a 3-2-1 buy down. It buys the rate down 3% in the first year. It buys it down 2% in year 2. It buys it down 1%. So basically, let's say your normal rate's 5% in year one, what would you be paying? 2%. And then the next year you would be paying 3%. And the next year you'd be paying 4%. And then the following year, finally, you're at 5%. So it's going to step up every single year until you get back to that 5% rate. Yeah, right. And hopefully you got a new job in between because your income better go up substantially. Remember, those 1% increases get real expensive. Really expensive. We don't need to talk about growing equity. That is it for chapter.
Did you say that we're not going over the GPM?
I did.
What about, so usury is going to be next chapter?
You don't even need to worry about usury.
Okay.
Yeah. Basically, usury is just certain laws that govern how much interest you can charge, but you're not going to be tested on that.
We need to know the CMT.
Nope. You don't have to know any of those indexes. None of those publicly traded indexes. Those are what interest rates are tied to in adjustable rate mortgages, but you don't need to know the indexes themselves.